Turnaround Tuesday, Warriors. How's everyone doing? Wrapping up this Christmas week in a few more days, 3 days. So, I want to start off with Euro Pound. This proves my theory. It only takes one instrument if you have the pulse of it. You don't have to be in 10 different markets. So I've made 3 calls here in face, live, last Friday down here. Well, a week ago last Friday. Down here at 87.60. And then yesterday said look to buy it around the big round number at 88. All right, Ziggy, how are you? Patrick? You guys remember those entries? So if you did it here, you could take half. You have about 48 pips here. And maybe even put in profit stops under 10. Of course, the big picture is higher. My theory of wedges says that eventually we're going to attack this wedge line up here around the 90 level. I know a lot of people have different views of it, but that's my view. So we start crossing this 200 right here on the 4-hour. To me, this would be the breakout measured move 90. Everyone with me? Okay, so we're close to our 9th month in face, and the analysis that I provide, of course, isn't here. I was brought on for a different reason than to provide the quantity and quality. There's quantity of quality here at ForexAnalytix between the whole team. So I was brought here to facilitate, share some of my ideas, bring in great guests to help edify the community. I think we have over 130 interviews or so since April. But I want to tell you guys something, that this would not be here without this. So if you want to say thank you and Merry Christmas to the team, take out a 6-month, 1-year subscription today. Because without this, you wouldn't have this for free. Okay? So that's my Christmas message. It's a season of giving, not just receiving. So you want to say thank you for the support that Face has given you for the last 9 months. Just like hundreds have already, then you subscribe right here and you do it to wish us Merry Christmas. It's the best way to do it. Actions speak louder than words. I've always believed that. Give me a Y if you think I'm crazy. And give me a Y if you think I'm out of line for making the request. But I do want to stress it that Face was an offspring of ForexAnalytix. It wasn't the base. It was an addition, of course, to give us more visibility so we'd have more subscribers. But I think that Face has helped a lot of people over the last 9 months. And if you're one of them, make it a 2-way street and use our traffic light page. You know, traffic lights are there for 2-way streets. And that's about all I have to say on making the plea. It's not really a plea, but I just thought it'd be a nice way to wrap up the year and say thank you for what Face has brought to the table to make you a better trader over the last 9 months.
Dale?
So, yeah, hi Steve, how are you?
Good morning, Coach. How have you been? I know you're a little bit under the weather, right?
Yeah, see, so maybe I'm a little crabby, but you know, a little bit. Yeah, dental issues, buddy. They're the worst.
Yeah. At least, you know, at least dental issues are superficial. They are annoying. They're annoying, no questions about it.
Yeah.
But at least, you know, it's
it's not cancer.
Yeah, if you want to put it like that, yes, it definitely isn't.
Because I've been there. So anyway,
I know.
Yeah, so it's trying. So I would think, Steve, that the euro looks like it still wants to finish the year better. I'm looking at this kind of like flag formation. Looks like if we got back through 1850 or so, that we could eventually head up towards that 120 handle again.
11850, 11870, that little area, let's call it a couple of
yeah, I
20,
could just
20 pips roughly, let's say. That's a critical area. If we break above it, yeah, most likely than not, we are headed towards the highs once again. And, you know, that remains the main case scenario for me. Only if we see it.
Mainly because of euro pound. You know, I use euro pound to really give me a bias on the dollar, you know, when it's heading up, because I've tried the other side, you know, when euro pound is strong, to try and be long the dollar and fade it usually doesn't work. When it's weak, it can work better. But euro pound to me still looks like it wants that breakout. It's right at this 200 here, Steve, and, you know, if we take it out, I think it was on the, oh, this is the euro. Okay, see.
Yeah, this is
So I had to take some painkillers. So anyway, yeah, so up here above this 88.50, 60 level.
Call it 70 to be on the safe side, because we have some upper wicks there, and I also have a horizontal support resistance area. But yeah, above that, we in essence trigger an inverted head and shoulders formation. You can easily see it there. I mean, it's not invalidated. It's still there, and yeah, that should bring you know, a decent upside, perhaps towards the 0.90 area, where we find a channel, and obviously,
that's
you know,
the target of the wedge up there. That's where the wedge line comes in, right around 89, 80, 90 even. So
yeah,
interesting.
I think that if we break above there, we will have at least another, let's say, 120, 130 pips of upside.
Yeah. And it looks like this may have been a failing rally in the dollar as well up here, Steve. You know, we sold off here on the Fed, and we rallied into the end of the week, and here we are almost right back at the lows. So maybe the dollar's going to end the year on its ass down here. The only caveat is, you know, when's the solstice? I think it's the 20th or the 21st. Winter begins. Gann said to keep an eye out for reversals on the change of the seasons. So there might be something there. But, you know, my bias still is that we're going to test this low out and take it out maybe into the end of the year, early January in the dollar. To me, you know, and this is the chart I want to use for tomorrow, Steve, on TFNN. It shows this tag, and comes in down at 90. This would clean out. And I know it doesn't seem possible because of all the, you know, the record spec longs in euro, but maybe they're going to be right for one more wave. And then if that happens, the market will probably even be longer and even more primed for a reversal.
Yeah, that's what extreme positioning, as we've seen in the past, is not an indicator that times turns. It's just one of the elements you're looking for to trust a turn in a market, right? But these two are two different things, because if you look at the speculators, like Blake showed yesterday, which is definitely something we have to pay attention to, right? I mean, I'm not dismissing that as evidence, but if you look at it, we've spent already like a significant amount of time with speculators being very or extremely bullish, and
they haven't been hurt yet.
Exactly, that's what I want to say. And despite having found a top like 3 months ago, did the people that were actually long get hurt? Not really, right?
No, as long as 117 holds, it looks okay to me. And, you know, can you imagine if it's a crowded trade now, that if this forecast manifests and we go down here to 90 and the euro goes 121 or so, how much more crowded that elevator is going to be?
Yes, obviously a lot more than now. Yes.
Yeah.
So you know, even people that, let's say, even large speculators that were going long quite late in the rally, let's say at 116, 117, 118 on the way up. I mean, during the summer, let's say.
Yeah.
You know, okay, they might have found themselves a little bit out of the money at some point, but people that invest, you know, large amounts of money don't use like 20, 30 pips stop losses. They're not scalpers. And definitely they're not going to be pushed away or out of their positions just because, in essence, we're seeing a consolidation period. Because in essence, in the grand scheme of things and looking at the yearly performance of the Euro USD, what we've experienced since you know, the top we found is it can be characterized just as a, you know, horizontal consolidation, right?
Okay, look at this. Here's the monthly 200 right here at 88.5, and I haven't done the fib work from down here, but to me this would just still could be a normal correction back down.
Oh yeah, absolutely, absolutely. And I think
8 level right here, 88, 88. So maybe that's the play, that we're down here, and then if we start to get some deflation or
and you know something, as we've tried to explain to people numerous times, any kind of position, mental or actual position you take in the markets, always has a chance of being wrong. But the question is, what kind of approach to the markets should you have in order for you to be more times right and not more times wrong? And obviously, the right approach is that in such a case, I mean, we've had now you're showing the monthly chart, by the way. We had, like, if you count there, we had 1, 2, 3, 4, 5, 6, 7 down months in 8 months. So some, you know, the dollar move lower was quite strong. Yeah. And if you see the recovery, it, you know, in comparison, it has nothing. Yeah, it has nothing to do with the momentum and you know, the nature of the move lower. So, you know, in all probability, the move lower was, you know, somewhat impulsive. The move higher is somewhat corrective, and this is somewhat in the sense that, you know, that doesn't mean that we have found like a high at the end of last year, but the chances that the dollar is going to move even lower from here are, you know, higher than the opposite. So that's how you should approach trading if you're not a scalper. Because if you're a scalper, it's a totally different game, because you are trying to take advantage of swings and trades that can be found on 15-minute charts and 30-minute charts. And, you know, if you go down to these kind of time frames, you can even find very, very strong moves that are completely counter trend to the medium or long-term
well, we've
bias,
certainly in 2017 have silenced the parity bears in Euro. You don't even hear that anymore.
Oh, I know. Anywhere, I have had multiple exchanges with people that were looking for parity, both for the Euro USD and the cable. When the dollar was trading at its highs. And, you know, I had multiple exchanges. I honestly never believed that the euro is going to break below parity, because the signs that the European Central Bank would sooner or later would have to start looking into the possibility of unwinding the monetary policies and QEs, etc., had already started showing, and the signs that the dollar was getting fatigued had already started showing. So these people, as many times we see, in essence were late in chasing a trend that was already at its last gasps for breath, right? For air.
Right. Yeah. Okay, buddy. Well, nice analysis, and you know, I like to look at things here a little more macro near the end of the year, and kind of think I'm already looking ahead to, you know, what could change or stay the same into next year. And right now, this looks to be the path of least resistance down here in the Dixie. So
yes, until proven otherwise, that's exactly what it is. Even if we get another push higher, it's still not going to change my mind. So, for example, you know, let's say that
97.
Yeah, let's say that we get from here, we find support, we get another push higher to 96, 97.
Right.
If the method, if the momentum, if the nature of the move towards these levels is not like extremely impulsive or whatever, I'm still not going to be persuaded that you know, this is the resumption of the larger trend up, but I'm just going to view that as another one more corrective leg before lower. So you know, my point of view doesn't change if we end up like breaking above 94.20. Of course, I'm going to turn more neutral in the short to medium term. Anyhow, one good thing about the dollar lately, during the past 3 months, is that it has given multiple opportunities to people to trade it both ways, and
Right.
that's always a good thing. I mean, you could have made or lost money being long or short the dollar at the same period. Depends on which currency pair you chose to do it against, because they were
you made a lot of golden nuggets about how when the dollar was rallying, it wasn't broad-based, kind of like the stock market, where you have narrow participation. You don't have the broad market confirming what an average is doing. And, you know, that was a great insight that on this dollar rally, it wasn't strong against everything.
No, it wasn't. It wasn't. While on the previous move higher that we had, like until the end of last year, more or less the dollar was uniformly rallying against everything. I mean, with very, very few exceptions, you know, in short periods. But it was uniformly, you know, rallying against everything. Patrick, by the way, asks, don't you think passage of tax reform will boost the dollar? You know,
isn't it in there already? You know, I mean, it's a done deal.
First of all, haven't we priced already? You know, quite enough of that. Second of all, yeah, as I said, not impossible, definitely not impossible, but
I think the market knows it's going to pass. I think the only surprise would be if there are a couple senators in the hospital. I don't know if McCain is out or not, but there's another one. If they can't make it to the floor, and isn't the vote, when is it, today or tomorrow?
Not sure, I have to check.
Yeah, I think it's because they want to have it on the president's desk by Thursday for him to sign, or Friday anyway. So the vote is in the next 24
you know
hours.
something, it's gonna sound stupid to you, but I've completely stopped paying attention to anything that has to do with the vote.
Okay, Ziggy knew.
Guys, it's
Senate tomorrow.
Yeah, House today, Senate tomorrow.
Yeah, okay. Yeah, all right.
I've completely paid. Hey, Steve, what's up?
How are you?
Hey, sorry, I didn't mean to interrupt. I just wanted to say that I think it's all baked in now. I mean, it's as good as done, the whole tax things.
One of the reasons I've stopped paying attention to that, Stelio, is this, and the second one is that, you know, I have no doubt that the market might find it as an excuse 1 or 2 more times to do whatever it's meant to do, but you know, once it passes, which is going to be, you know, rather soon, that's it. Then we actually need to see, you know, then this is going to stop being an excuse for the market, and then we need to see, you know, what it actually wants to do. But regardless, I would completely ignore. I mean, my only dollar position that I have left on the table is being gold short, and that's because I'm in the money. So, you know, I'm not risking any, at least I'm not risking, you know, to have any losses from there. And being short Euro USD NOK, which I'm roughly at the money at the moment, and I'm not really worried about it. And obviously, I'm not looking to establish any fresh positions, being almost at the 20th of December. And I would advise people to most probably, you know, do the same. Let these days pass, see how the new year starts, a first few days, get liquidity coming back in the system, so you can then at least trust whatever moves we see, because we can see during days of very low liquidity some firecracker moves that will be backed by nothing, just by a few billion coming through the market, sometimes to just manipulate some expirations, etc., and might be completely reverted, like the first trading week of the new year. Yeah. So don't get trapped in that kind of volatility. Yes, Telio?
Yeah. The other thing I want to say is something I look at every day. If you look at what's priced into the US market now, January 18 to January 19 Fed funds are pricing exactly 50 basis points. So 2 hikes in 2018. The Fed is telling us that they think it's going to be more like 3. So in regards to the dollar, I'm with you, and I think I've shown this chart many times on the webinar as well. I think there's a chance of a push towards 96 for the dollar, for the DXY, and then it goes all the way down. And I am personally looking for a bounce like this on the dollar to get short.
Yeah, because let's be honest, Telio, at the very maximum, if for the first time in many years, the Fed's guidance proves to be not more hawkish than it will end up being, because usually we get a guidance that's more hawkish than they end up being, right? They always find an excuse to do less. Yeah, they always find an excuse. But even worst case scenario, that this time they're exactly on point and they do deliver 3 rate hikes, the market is just pricing 1 less rate hike for a whole year. That should not be enough to produce any big moves upwards, right?
Personally, if we get to pricing like 2.5 hikes or something like that, that's my cue to get short the dollar. And remember, for 2016, the guidance was 3 to 4 hikes, and they hiked once. So and also we have to remember that what's inflation doing? They're hiking. They've hiked 4 or 5 times now, and inflation is stable. So as they're hiking, which way is that going to go? It's unless something drastic happens, there's no way it's going to reach 2%. So my gut feeling is that they're going to stop earlier than they want to, but remains to be seen.
It also has to do with the business cycle, of course, because some of the previous times they were hiking, they had to stop and reverse simply because the economy imploded, right?
Yeah, absolutely.
Yeah, and
so,
and we have. Speaking of that, let me share my screen. Speaking of that, and something I've mentioned multiple times, this is, the current market environment. We are already in an uptrend for 8.7 years. Okay, and this is already one of the longest recoveries we've had since the beginning, the second longest recovery we had since 1900s, right? So the question is the following: the one that lasted more, which was, when we're talking about more, we're just talking about half a year more, but it did produce a lot more, a lot more gains having to do with the stock market, was the one that led to the Great Depression in 1929. So we've already recovered. I mean, this is like the 3rd longest recovery having to do with gains, and the 2nd longest recovery having to do with longevity that we've had since 1900s. So, whatever assumptions about the market are based on the fact that, okay, we might get a recession in 2-3 years from now. I'm not saying that it's impossible, because, this is just an indication of what has happened more or less to the previous business cycles, because as you understand, more or less, the market gains and market drawdowns are almost aligned with the business cycles that we've had, right? So the question here is not if it's possible. Anything is possible. But the question is, does this feel like a market based on facts that can actually push it to be the longest one ever by a big margin? I'm not telling you. It might last another half a year and we can actually this might actually become like the longest one we've ever had, right? But does it feel like the fundamentals, debt, deficits?
Steve, there's another analog with what happened in the late 20s and 30s, is that the Fed in 1937, thinking that the economy was, out of the woods, tightened again, and we had another little mini crash, recession.
That's very true. That's very true.
Didn't come out of it till World War II. So, what's the Fed doing now, the last year and a half? So there is that possibility, and who knows, maybe, but, I'm only expecting maybe only 20–30% correction from wherever we peaked back to 2100 or so, and in the S&P, and then maybe the Fed, they're not only done tightening, but perhaps they reverse course again. So that there are many analogs to what happened in the late 30s to what's happening now.
That's a good, Dale, that's a good point. And one other thing I want to say is that this chart is very interesting, this graph. But we have to remember one thing: things changed a lot after the crisis in 08. I mean, these peaks usually were correlated with periods of economic growth and recovery and all that. Now it's just showing us that the performance of the stock market, which we all know is not any more influenced just by how well things are doing in the economy. We've had this.
Yes, there is though one interpretation.
He said I was shining shoes outside the NYSE in 29.
In 1929, yeah.
Go ahead, guys.
Yeah, but Stelio, this is though a double-edged sword. I mean, by the way, guys and gals, as you see, we're having more of a macro conversation, and we're going to go back to charts. The reason we're not, in a haste going back to charts is because since we saw everything yesterday, more or less the market has done almost nothing. So, I'm going to check into the charts, in a very few minutes, and obviously you can ask questions about specific currency pairs that you want or whatever. But I have to tell you in advance that nothing has moved enough to change our technical bias from what we were seeing yesterday. So, Stelio, coming back to what I was saying, this is a double-edged sword, because the fact that the last 3 business cycles, the last 2 for sure, we can testify and we can be absolutely certain that they imploded due to bubbles being created to the economy. I mean, everybody accepts that now in retrospect. And I'm more or less convinced that we're going to be of the same opinion once this implodes. The problem is that until then, the economy's performance was guiding the asset prices and the stocks and financial assets higher, while now more or less the opposite is happening. So now we're actually producing financial asset performance to stimulate the economy instead of stimulating the economy and expected financial assets to perform because of that. The problem with what I described is that once the stocks rally snaps, which inevitably is going to happen sooner or later, since that's the main reason that the economy actually ended up recovering, is that the move lower is going to be spectacular.
It's a bit of a paradox, isn't it?
Yes,
the way
it
things
is.
Change. Yeah. I agree with you. I think, where's the top? I don't know. I've been very skeptical of these equity markets for over a year now. I haven't shorted anything yet. In fact, I've been picking some specific stocks to go long of every now and then. But I think as well, at some point this is going to stop. And what happens then? What happens with the Fed and their rate moves? As soon as we get any decent correction in stocks, you've heard them. You've heard all the Fed, the governors and all that. They come out and they're very, very dovish straight away. So I think as soon as we see any kind of reaction lower in the stock market, and I don't mean a 1 or 2 day move, something material, that's it for the Fed. So I don't know.
Yeah, but one day. And one day that's, trust me on that, not going to be so far away. That's not going to be enough, right? Because something is going to happen and just the Fed showing a more dovish stance is not going to be enough anymore to calm down the market jitters. So,
I agree.
And when that happens, as I hear Dimitri agrees as well, right?
yeah, sorry about that.
One day that's going to happen, and that's not going to be far away. Jason is asking, any thoughts on why this business cycle has gone so long? Central banks? Answer, absolutely.
Yeah,
absolutely.
Cheap money, you know, zero cost money essentially. So, and the other thing, you know, bond issues by companies, even like Apple, who don't need the cash, they issue bonds and they buy back stocks.
Yeah.
There you go.
So, yeah, you know, there are a lot of, in quotes, unhealthy practices that has kept this rally going. And that does not mean that you should be looking to be short now, right? Because the same unhealthy practices can keep working for months. But trust me when I tell you, you know, when you're walking on like, you know, half broken legs, once you get like a, you know, a strong earthquake in the markets for any kind of reason, and once the market loses for A or B or C reason, and that always happens in life, it's trust that the backstop of the system that has been working since 2009 can work. Then it's going to be who runs for the exits faster.
That,
and then
that makes me think, guys, that it's not going to be an economic issue, that it's going to be an exogenous event. And I agree.
As a catalyst, very likely. Very likely, yes.
You know, if you want me to say what it's going to be a war with Iran. It's all laid out. Trump's first visit to a foreign land was Saudi Arabia. Israel and Saudi Arabia are allies. The enemy of my enemy is my friend. There's all kinds of things happening in Yemen now. And we have a new guy in charge in Saudi Arabia. And to me, I think that's really going to be the catalyst. We're decertifying it. President Trump is talking about Iran. Everyone's worried about North Korea. I think it's going to be the Middle East, which will probably have more economic implications, with energy being a chokehold on the economy for a while. And that, to me, is my no Sir Pinkert call for 2018. That what derails the market in a bigger way than any kind of normal technical correction is going to be an exogenous event, nothing driven by central banks. That's my opinion. You know, take it or leave it.
Might be the case, but whatever the catalyst is, at some point the market is going to question the ability of the central banks to backstop a sell-off. And you know something, when these kind of jitters start affecting the big positions, then this becomes a snowball, right? This creates a snowball effect. And then there is no backstop until the market can actually overshoot to the downside, as we've seen it do many, many times. Because let's be honest, the SPX 667 level that we reached after the great recession we had in 2008, 2009, was obviously too low of a level, right? I mean, that also didn't represent the actual worth and potential of US companies or the US economy, right? So, unfortunately, due to intervening, you know, theoretically speaking, the markets are the epitome of what capitalism does. And supposedly, US is the #1 capitalist country. But if you see the practices in which we're trying to affect the economy, it's completely against anything that capitalism stands for. Because capitalism is not for, you know, supporting or whatever. It's about leaving things on their own, do what they can do, let whatever company is to go bust, and let whichever company is able to perform, you know, have its valuation like increase no matter how much, you know, whatever the market thinks it's worth. And actually, we've been doing the exact opposite. And that creates extreme moves to either side. And that's why I'm very skeptical that we can see a 20% move lower and just be a 20% move lower. Okay. That's the reason I don't so much agree with your assessment that we might see a 20-30% move lower, because I find it hard to believe that if the unwinding begins and we reach the point of being minus 20, that there is any kind of force that can actually put a stop there.
Okay. And
anyhow,
opinions. Bill thinks there'll be peace. He thinks a war is being priced in. So
I hope it's right.
Breaking out. Okay, so that's Bill's opinion, and it could be there. Gary's bringing up a point that it could be the bond market. I mean, Martin Armstrong's been looking for a sovereign debt crisis for a couple of years, and let's face it, the bonds haven't made new highs in years, and the 10-year yield hasn't made a new low in years, and it holds together, and we get bear market rallies since the election, but the trend is still pretty negative in bonds. And eventually, like in '87, there was a long enough period of disintermediation, and that was happening with the dollar falling as well in '87. So we had a weak dollar, we had a very weak bond market, and that was right before the Plaza Accord, and that caused the '87 crash. So the bond market can be in a bear market for a while before it catches up with equities on a valuation basis. Maybe that's what's happening here.
That's a good point and a nice historical review, actually. Yeah. By the way,
well, I'm old, man, so I didn't read about this stuff. I lived through it.
You actually lived through it. I know.
Yeah, like Ziggy said, I was outside the NYSE, shining shoes, giving stock tips in 2090.
Yeah. By the way, our friend Gary is telling us that the bonds are actually on the move, and he's very, very right. Actually, let me show both the bonds and the 10-year treasuries, because they are definitely at least treasuries at the moment at an inflection point, because as you see, they're at the bottom of this wedge, which also coincides with this horizontal support area and the 78.6 from the move that, the corrective move higher that we found since the lows. And, more obvious than not, if we actually break below there, that should accelerate to the downside, and probably, it's going to be another nail in the coffin for, the long bond trade, at least in the medium term. So, very, very key level here. And let me also show the bonds. The bonds are not in such an inflection point, but I have to say that yesterday's rejection from this diamond formation that we're monitoring gets confirmed with the acceleration we see lower today. And, this already completes a 3-month consolidation in the bonds. Obviously, there is not much to do at the moment because we are back again in the middle of this diamond formation. And even this diamond formation is part of a large triangle, as you see here, a flat bottom triangle. So obviously the bonds are not ready to do a big move as the treasuries are doing, but they are on the move today nevertheless. Okay, so thanks for letting us know that the bonds were moving at this point in time. Kimster Raika, let me guess, that nickname comes from Kim Raikkonen. No, I'm kidding. Might be actually. Okay, let's have a look at the USD card because he says it's bull flagging on the 1-hour chart. Let's go down to the 1-hour chart and have a look.
I think you can have your chance to sell it next week, Steve, or early January. Looks like
bull flag to me. Bull flag, I wouldn't call it, but it's definitely.
And how about a pennant?
It's a triangle. Yeah, it's a triangle, a pennant. Yeah.
Oh, there you go. So triangle for a floor and a thrust to 61.8.
Yeah, very likely because this kind of consolidation after this kind of a move, statistically speaking, it should break to the upside. So I'm in agreement with you, mate. And you know something, I'm looking forward to it. I want to see USD CAD break to the upside. I'm waiting for that to happen so I can short it at higher levels. Oh, he agrees. Yes, go Kimi. So are you finished, by the way, or just a fan of Kim? Okay, you're not, but a huge fan. Okay, I'm a huge fan of Ferrari. I have to tell you, unfortunately, Luca I know is gonna agree with me on that. But yeah, Kimi Raikkonen, a great driver.
I'm a huge fan of ForexAnalytix.
I'm a huge fan of ForexAnalytix as well. By the way, I just wanted to say, since you mentioned it before, for people that haven't seen our product, ForexAnalytix is not just the traffic light page that you see here.
Oh yeah.
It's also the analysis page you have behind it. So the traffic light page is like, it's just a page to give you a basic, fast review of everything. Yeah, exactly. And the analysis page is the page that you're going to find yourself when you want to read the analysis, look at charts, calendar events, news, etc. So, ForexAnalytix, for our paying subscribers, consists of 2 pages. One of them is to give you, detailed analysis. The other one is to give you an overview.
Great combination you and I are, Steve. You give rational reasons for subscribing. I give emotional ones, like I was trying guilt today. Being born Jewish, converting to Catholicism, I'm an expert. So if I could sell guilt, no one could sell it better than me. So you guys, do you feel guilty that you haven't subscribed yet? You should. But
I think you are a natural, and you can even sell fridges to Eskimos.
Anyway, I had great training by my mother and other women. Oh.
I'm not going to ask for details. I take your word for it.
All right, buddy.
Okay, so USD NOK still, refusing to penetrate through the 840 level. To be very honest, I'm short from just below here, but I would also like to see a cleanup of the stops at 840. For example, at a thrust to 845 or whatever, before it reversing. It's going to look like something I would expect in the market, especially during holiday season, right? So if I see any type of move breaking through 840 during the holidays with very, very low liquidity, I'll actually consider adding higher for a reversal, once liquidity comes back in the market. USD SEK is more or less in the same type of situation. It has been rejecting the 61.8 and this horizontal resistance area. Once it breaks below this ascending trend line, most likely than not, it's going to accelerate lower. So that's what I'm monitoring. There is no real update we can give about the cable. The cable remains in this choppy trade within this descending channel. Call it a bull flag for the time being. I still view it as a bull flag until proven otherwise. And above the 133 support area. So, that's a very critical area. As long as we trade above it, I cannot possibly turn bearish because, we will not have even broken like a single important support area. So, without breaking that, I have no reason to be looking lower. Only if we break below that, then I'm going to start considering, bearish interpretations and possibilities. Now, having to do with the Euro USD, you pick your poison here. You want to be bearish, you can be viewing this as a head and shoulders formation and hope that it's going to break below 117. So you get confirmed and you see some more downside coming. But on the other hand, if we break above, this horizontal area, call it 11860, 11870, first of all, the head and shoulders interpretation gets invalidated. Second of all, what gets validated is the general viewpoint that this was a 9-month move higher, and what has followed since looks like being some corrective consolidation. And it's bound to break to the upside. I mean, so you get your two interpretations. You know at which level each one is correct. The chances, statistically speaking, is for a break higher, but being the holidays, you never know. But you know which levels to watch. It's 117.10 and 118.70, let's call it. Okay, break above the latter one should bring more gains for the pair. Break above the former one, 117, 117.10, should bring more weakness in the short term. What else do we have? Stock market's nothing really to say. Another day of gains yesterday, and you know, not really many levels we can be viewing here. At some point, probably might even come, you know, in after New Year's, everything will have been priced in. Some people will want to take some profits, and we should see some corrective move lower from there. But unless or until we see that, and we can interpret it, you know, its form, and see what kind of a momentum it has or whatever, you know, this drift higher can easily resume. I mean, nobody can guarantee that it can happen. I mean, we've spent almost a year going higher with minimum or no corrections for a period of time. I mean, I don't even remember when was the last time we had like a 5% correction. So, you know, this market is like extremely strong, and probably this is not the proper period of time to try your luck to the downside. As I said, probably, you know, after the first few days of the new year come, we might see some pullback, and we take it from there. Yeah, ZAR. Thank you. I mentioned USD ZAR in the chat room yesterday, but you know, those of you that are not in the chat room obviously don't know that. You know, I made money being long the USD ZAR twice. I had said that in the webinar as well. I was telling what I was doing in my positions, and I was really lucky, I have to say, because I was looking into being long once again, with the possibility of this being a descending wedge, but I got lucky and the market didn't produce some kind of a false break higher. So I never got triggered. I was actually monitoring this as a descending wedge when we were trading around here, and I was monitoring this horizontal support resistance area. So in case we made a move higher from there and we actually closed above the 1375 area, I would go long again. But the market actually collapsed lower, and it actually even broke below this trend line, which makes the interpretation of this move simply a corrective move, right? Because we had a strong move lower, and then we had this move higher. At some point, this move higher seemed like accelerating above a triangle. Actually traded very perfectly, because it broke above the triangle, it came back, it retested it, it moved higher once again, but then it completely failed. So zooming out, that's not like a huge surprise, since we came in this triangle and then this thrust higher from a strong downtrend. We retraced roughly 38% of this downtrend, and now we're breaking up below once again. So, in my opinion, don't try to fade this move. Most likely than not, if you're looking to trade this, I think that the proper side to trade it is perhaps to look like to something like this. So I have to tell you that despite having traded rather recently the USD ZAR twice to the upside and being successful with it, I would be looking to trade it to the downside from this point on. So any move higher to retest this trend line, or even this horizontal zone anywhere, let's say between 13, the 13 handle, 13.10, 13.15. If I see a rejection from there, I'm really going to be looking to align myself with the trend and go short. So I really think that if you're looking for USD ZAR trades, you know, from this point on, you should be looking, you know, to be short and not to fade it. Thank you for reminding me, by the way, because I wanted to show it yesterday as well, and I completely forgot. Paper money, they got the fire live on midnight special. Check this out. Mainly paper money on YouTube gets the blood moving. I was a big fan in those. Okay, just check the suggestion from Tom Dale. I'm going to copy it in
okay.
in Skype for you. There it is. Okay. Okay, let's see what else. Let's have a look at the Aussie and the Kiwi. The Aussie is consolidating near the highs. This type of price action definitely does not look like a potential reversal to me. So I'm still inclined to believe that the Aussie should produce at least one more move higher, either from here or from a little bit lower, before actually, reverting to going back to a downtrend. And more or less the same applies to the Kiwi, right? It has also broken above the corresponding critical resistance area at 0.6970. It has been consolidating in what looks more or less like a triangle just on top of it. Most likely than not, it's going to resume to the upside for at least one more leg higher. So in my opinion, too early to fade Aussie and Kiwi strength, too early. Okay. Any questions? Anybody else wants us to check at anything else? I know that these have been quiet days and we already looked at them yesterday. Let me have a look at the USD yen. USD yen, really nothing to see here. As we've said plenty of times, it's good for you to zoom out here so to get the big picture. And the big picture is that to the upside, we're being capped by this very critical trend line, this blue trend line. But at the same time, we're also we also cannot turn like overly bearish because this has been a prolonged consolidation, right? So for us to be looking lower, we at least need to see a break below the 111 area.
Pretty muted response to the bonds about to break to new lows.
Yeah, absolutely. Actually, absolutely, completely muted response. Yeah. But on the other hand, I have to say something as well, Dale. In the very short term, if we want to see this in the short term, and let me go back to a 4-hour chart. If we want to see this in the short term, and let me go back to the daily so I can show it in duration. We had a very strong day lower, this one.
Yeah.
And we've now spent like 4 days in a very, very slow recovery, and we haven't even retraced like we haven't retraced more than like 40% of that. So this type of price action after that strong move lower tells me that tells me that it's more probable that the next leg is going to be to the downside as well, but that doesn't mean that it's going to be something strong. So if I had to be short or long the USD yen, which I'd rather be neither of that at the moment, it would be short at the moment.
Yeah, I think Greg is looking for 110, and he's a long-term bull. Just something that
it is very, very likely. It is very, very likely.
ForexAnalytix subscribers would know, and non-subscribers would not know until I just said it.
True, very true. Very true. We have a good question here, and I say it's a good question because it has been bugging me as well. Charles says, does the weekly daily FTSE look like a rounding top, and how you might play it?
Looks like a rectangle.
Something, in all honesty, this is a range. The only thing that would get me believing that a break to the upside is more likely than not is the false breakdown here in this area. Other than that, this looks extremely similar, and I'm not a fractalist, but I don't find it a coincidence either. This looks extremely similar to Euro yen, right? Look at it.
Yeah, it does.
Euro yen?
Yeah.
FTSE, right?
Only a little more progressed, but yeah.
Yeah. In this case, what I would tell you is the following. We find ourselves now in, 7-month consolidation. It's been so long, I didn't even realize it. So we've spent like a period of 7 months in this range, but we entered this period of a consolidation after a very strong move higher. Very strong move higher, followed by a consolidation.
But what a massive underperformance the last 7 months compared to the US. Wow.
Yes, you're right, Dale, but statistically speaking, a period of consolidation after a strong move higher
leads
usually gets a result to the direction of the trend. In this case, higher, right?
Yeah.
That being said, obviously getting long near resistance is absurd, right? So trying to buy prices near 7,600 absolutely makes no sense. So let's take a ruler here. We moved 38.7% higher in roughly a year and a half. That's a huge, huge move higher, right? 38.7% higher in a year and a half.
And that was with the pound going down.
Yes, of course. And big part of the move was due to that, right? And now we spend 7 months consolidating, which is, as a ratio, it's a healthy period to consolidate a strong move, regardless if it's to the upside or to the downside. Bottom line, I would expect that the resolution from this range should be rather near and not far away. Okay, and I would be more inclined to trust a break to the upside for the reason I explained than the opposite. So that's my view on the FTSE. Robert says we have BOJ this week. That is very right. I have to tell you though that I'm not expecting anything. Yes, you're right, but I would really have no expectations of any real movements following that. Of course, you never know with central banks, but and at a side note, unfortunately for them, the market has showed that it's not really paying attention so much to the BOJ. I mean, the other time that they came out making extremely powerful dovish comments, like what was it, a month ago, Stelio? The market didn't care at all. Actually, we found the top like next day or something, a short-term top, which isn't the response obviously Kuroda and his friend would expect. Okay, our friend here wants us to have another look at USD PLN. Let me remember in which window was it here? No, it wasn't. Was it here? Yes, it was. Nothing has changed to it. As you see, last time we checked it, this is the formation you should be watching. A break to the downside below 350, let's call it roughly, definitely brings another leg lower, while we need a break above 365 to consider a stronger recovery. So, potentially there is a good trade coming up here, but we're not there yet. We are within this flat bottom triangle, and as long as this contains price action, although the chances are for a resolution to the downside, you'd rather be more patient. Okay, from what I know, we don't have an interview today.
Buy your pierogies and kielbasa after we break down through support. You might get an edge at the store.
So from what I understand, we do not have an interview today, right, Dale? So we wrap it up now?
We have a great one tomorrow, Konstantin Gurdjieff at GT Cost. And the guy knows a lot about central banks and, what the Fed is going to do and currency. Should be a great interview. And then I have another very good interview with Joseph Dietz on Thursday. And then I have Saeed Zaman, which many of our FACE community have been requesting. This is a rescheduled interview at Trader SZ. So he has a pretty good following. We'll wrap up the week and say Merry Christmas on Friday with Saeed.
Okay, perfect. Sounds like a good plan.
Okay, buddy. So
okay. Thank you, everyone. See you tomorrow, and those of you that are in ForexAnalytix, I'll see you in the chat room.
All right. So I love you, Steve. I love you, Stelios. I love all you guys here in Face. Have a great day. Go enjoy the season. Money comes and goes. Time is gone forever. I know a lot of people, they count their life based upon how many more Christmases they might see. So enjoy this one, and we'll be back tomorrow full throttle with an interview. And I don't know how everyone feels. I can't wait for the beginning of 2018 and markets to get back to normal. So Merry Christmas to you, Tom and Luca. And our thoughts are that Blake has a great trip to New York and he becomes a Bloomberg expert. And really, guys, the best way to say Merry Christmas to us is to become a subscriber. No, we're going to go next week too, Luca. We're going to go, we'll be closed Monday, but we'll be open for the remainder of next week into New Year's. And then we start 2018. And I don't know what you guys think, but I think it's going to be a killer year, and we're going to kill it all together. So remember to just count your pips, count your blessings. Thank you very much, Luca, and everyone, and see everyone tomorrow. Thank you, Steve. Thank you, Stel. Adios. See everyone tomorrow.